Qualys returned 23% in 2023, just underperforming the S&P 500 by a few percentage points. And in fact, the year was a very, very wild ride. Just look at the surge from May all the way up to July 2023 to then lose all of that value by November 23 to then gain it back by the end of the year. So this means that this stock presents great buying opportunities, and in fact, it has great management, it has a moat, it has great growth projections, and it is in a very fast growing industry. This company has solid fundamentals and efficiency ratios, and it has a big market share in a growing industry. So we'll be looking at Qualys, a cybersecurity company. In their annual reports, they describe themselves as the leading provider of a cloud-based platform delivering IT, security, and compliance solutions, which basically means that they help organizations protect their systems from cyber attacks. And we know that cyber attacks are really popular right now. There are a lot of companies spending a very big chunk of their budgets just to protect themselves from cyber attacks. And additionally, they help achieve compliance with policies and regulations. And this is also a very big trend, since every year there are more policies and more regulations, which forces every company out there to update their compliance constantly. So Qualys tells them, you know what, we can do that for you in exchange of a fee. And this, in fact, has a very high rate of returning and repeat customers, which is part of their moat. Then their main advantages of their service is that, first of all, there is no hardware to buy or manage since it's a platform. They have real-time visibility in one place. You can access it from the computer, from the phone, from the tablet, even if you're out of office. It has seamless scaling. So for example, you can start with a very small portion of your business and then scale it up to englobe your whole operations. And it is constantly getting updates to the compliance part of the business, and of course, to be updated with the latest cyber attacks technology. Their growth strategy is developed into 4 different periods. The first one is to develop new security solutions through research and development. The second strategy is to increase cross-selling among existing customers. And what this means is that they currently have a lot of customers that are being offered a service or are using the platform, but only a small part of it. And what they mean by cross-selling is to sell their existing clients, so these clients that are already using a part of their services, the other services and products that they offer. This is great because it generally has lower sell cost than looking for new clients, and it can create an even wider moat, since if you have one client using every single one of your tools, they will be repeat customers for sure because they will have high costs of replacing you. The next one is to drive new customer growth and broaden global reach. So this is the opposite. Instead of selling more to their existing customers, this is more of a sell to new customers. And then finally, explore acquisitions to improve their current offering. So they know that they have to innovate, and sometimes just by doing research and development is not enough, since if a company gets a breakthrough and they get a patent on one of their services, no other company will be able to provide the same service or do it in a similar way. So just by exploring acquisitions, they are able to gain a lot of intellectual property, which they wouldn't be able to get just by R&D. Their financial analysis looks great. They have a 19% return on capital employed, which is incredible for a company this size. Anything above 10% is good, and a 19% is absolutely great. They have a very solid interest coverage ratio of 100 times, meaning that right now they don't have any liability risk, and they have a very solid cash conversion of almost 150%, meaning that they're very good at converting their net income into free cash flow. Their profit margin is incredible at an 80%, and their operating margin is almost 30%, so it's sitting at double of what we usually look for in a company. Their annual revenues, annual gross profit, and annual net income have been growing every single year, and you can see that their margins have been fairly stable. Of course, their gross margin has been incredibly consistent, sitting at around 79% since 2013 all the way up to now, so 10 years of that margin. And their net margin has been moving up and down, but it is sitting right now at close to 20%, which is amazing. Their efficiency ratios are now through the roof. You can see the return on invested capital, which is the one that I like to focus on. It's right now sitting at 95%, meaning that this company's management knows exactly what it's doing. In terms of a fundamental analysis, this company is as good as you can get. It gets a solid 8 out of 8. They have very low liability risk, as we have concluded from the interest coverage ratio. They have an extremely solid balance sheet, since they can pay off their current liabilities with their current assets, and they have a very solid cash position. They provide extremely consistent cash flows that grow organically, which is extremely important for a company that also wants to do acquisitions. The one that I was less inclined to put a tick on, but in the end I did, was the small share buybacks, because normally this category is combined with a dividend and Qualys does not pay a dividend. But since they are actually conducting share buybacks instead of issuing new shares, this is a tick for them. It's a positive trend. And then their organic revenue growth, of course, we have seen that the majority of the growth has been consistent and it has not been funneled only by acquisitions. That's just a secondary part of their growth strategy. And this company, of course, due to the repeat customers and the attraction pool that they have with all the solutions that they have a very good existing moat, which gives them a competitive advantage and allows them to, of course, set the prices, giving them pricing power. These fundamentals look amazing, and it basically is the definition of a monopoly. They have a very big moat, they have pricing power, they can grow their revenues organically, they're free cash flow, and they even have low liability risk. So let's move on. Their long-term analysis looks great. They follow secular trends, as for example, they're implementing all of the new technologies from AI to big data. They are in the industry of cybersecurity, which is an industry which follows every single secular trend since it's very popular right now and companies are really scared of cybersecurity attacks, so they're investing heavily in this area. Two main avenues for growth. The first one, as they are already tackling, is leveraging cross-selling, meaning that all the big clients that they have right now, selling them more products and more services. And if they are satisfied with the service that Qualys is providing on the different services, then this will be an easy way to sell and increase their revenues. And the second one, which they also are tackling right now, is to attract new clients. Now, moving on to the valuation, which is the part that you guys most love. In terms of a PE ratio kind of standard, it's currently trading at around 50 PE ratio, which when compared to the previous 3 years, it's looking right about average. I would say, however, that 50 PE ratio is a PE ratio that only very high growth companies can hold. So of course it's trading at a premium due to the solid fundamentals that it shows. Using 2022's free cash flow, it displays a yield of 3.34%, which is higher than the 3% long-term inflation rate. And this, according to Terry Smith, is the way to tell if a company is attractive or not. And especially since Qualys is growing, it is at an attractive valuation. However, if you're scared of the high PE ratio, you might just want to wait for a pullback. As we said in the first slide, this company goes through wild rides all the time, so the price will probably dip in the following 6 months. In terms of risks and possible challenges, the main risk I see is competitors. Since this industry is so profitable, it has a lot of players in it, which are constantly innovating and coming up with different solutions. So for me, this is a 70% risk because you never know what may happen in an industry of this popularity. In terms of regulations, there are as well a lot of regulations affecting this space since it's very sensitive. It targets cybersecurity attacks, which are one of the main sources right now of worrying amongst big corporations. However, I see no possible bad regulations coming up on this industry in the short term. And then performance and market, I don't see any risk since companies will still have to protect themselves from cyber attacks in economic downturns. And this company has been meeting their performance objectives for 10 years plus, so I don't see a problem with this. Before moving on to the investment conclusion, please remember I'm not a financial advisor and this is not financial advice, so do your own research before purchasing the stock. However, I believe that this company has a solid moat with consistent cash flows which are predictable and resilient. It has a very high return on capital employed, which means that it is good at creating value for the investor. So I think that this is a good company that may generate high returns, and I will put it on my watch list, and if the price falls again, I will be sure to get onto it. So if you don't want to miss out on those news, there is a link to join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic. Thank you for watching.